Welcome to the Balanced Income Feedback session, focusing on the risk budget, makeup of underlying funds, consistency numbers over rolling periods, the investment growth, and attribution figures. Really a tricky year to date across all asset classes, locally and globally, as markets focused on rising inflation and very aggressive rate hikes from most central banks across the world. Tough place to be in fixed income markets at the moment, but thankfully the balanced income has provided the necessary protection. Looking forward, local inflation still ticking up and above 7%, and there are fears that this will become out of control. But we are confident that the Reserve Bank is on top of this, and we are expecting further rate hikes and seeing some stability returning to the markets towards the end of 2022. Local growth very resilient than initially thought. Rand continues to perform well relative to other emerging markets, and our terms of trade still elevated, as well as the commodity boom contributing. Global flows slow, mainly to global inflation fears, and will stabilize when inflation peaks in the US, UK, and Europe. Year-to-date figures. If you look at the different indexes and asset classes, money market produced 2.6%, the all bond index flat, the all share index minus 4.43%, local property at 4.99%, global equities producing minus 10.87%, the global bonds at minus 8%, and global property at minus 9%. The objective of the balanced income is to deliver a return between cash and 4% above inflation over any 5-year rolling period. Deliver a return of more than cash with a 90% probability over a rolling 5-year investment horizon, and it tries to limit downside risk over any 12-month period and focus on generating a high level of income. The typical investor that would invest in the balanced income is an investor that is worried that their money outlive them. They don't like any short-term to medium-term volatility within their portfolios, and that they are certain that they would be able to buy bread and milk in the following month. This is a very anxious investor, passive in its investment decisions, and very emotional. If you look at the makeup of the portfolio and the risk budget, you would see that the risk allocation is 50% in defensive assets as well as 50% in growth assets. When we look at a further allocation, we divide the portfolio up into income and growth assets, income assets as well as growth assets. 25% is allocated to income and growth assets, 25% to growth assets, and then 50% in income producing assets. The underlying funds, as you can see, is divided up into the 3 different areas: income, capital growth, and income and growth. The first area, income, is represented by the 91 Corporate Bond, the Marriott Core Income Fund, the Stanlib Bond Fund, and the Amity BCI Diversified Income Fund. The growth allocation is allocated to the Amity BCI Global Diversified Fund, and then the local equity managers Aylett and Fairtree. The income and growth category is represented by the Amity BCI Equity Income Fund as well as the Sesfikile BCI Property Fund. When we look at rolling returns, this graph needs to be seen as a rolling period. So each one of these points within the graph represents a 5-year, 1-month shift. And one can see with the 2 bands that we have allocated, cash and inflation plus 4, you can see that we are within that band over these 5-year rolling periods. One can also look at the consistency in the table above versus inflation over 5 years, as well as achieving inflation plus 5 over rolling 5-year periods. From an investment growth point of view, if you invested 100 Rand since March 2021, and one can see this is a very short term, but still representing the bands of inflation and inflation plus 4 versus the balanced income, and also comparing it to the medium equity sector. When we compare these, the balanced income to the different assessor categories, the low equity, the medium equity, as well as the high equity, one can see that the risk management year to date is less within the medium equity versus the high equity. And when we look at inception numbers, the balanced income producing 6.32% versus 5.2% from the below assessor categories. When we do an attribution, we look at the makeup of the return and where the returns come from. As you can see, the neutral represents the strategic asset allocation. This is the research that we've done to see how much we need to allocate to local equities, local properties, global equities, flexible income, local bonds, etc. And you can see this has contributed 6.31% of the return. Manager selection was positive, slightly positive, and asset allocation, that means moving away from our neutral position by having overweight in bonds as well as in local equity, had detracted marginally, and that produces a positive return of 6.32%.
This was a yearly feedback session focusing on the risk budget, makeup of underlying funds, consistency numbers over a rolling period, and the investment growth and attribution figures. This concludes the yearly feedback sessions. Should you require any further information on any of the solutions, please contact Tanya Kutsia, our Advisor Experience Manager.